Welcome back to the Talking Hedge, your cannabis business podcast. I'm Josh Kincaid. Want to cash out of your cannabis business? Here's some things to consider. As mergers and acquisition activity accelerates across the cannabis industry, many companies are discovering that they don't need a for sale sign in the window in order to be a takeover target. The flurry of M&A activity, which is on pace to double in the cannabis industry this year, is giving more cannabis founders a chance to cash out at an attractive price after years of working 24/7 to build their businesses. It can also provide a founder with a hefty pot of cash to launch their next venture. As more companies become potential acquisition targets, here's some things businesses and their founders should consider before a buyer comes knocking on the door. Starting a competition among prospective buyers, building your company's brand, determining your business's worth, putting good corporate governance in place, hiring the right business broker. For the firms on the selling side, creating competition among prospective buyers is critical to commanding the best price. You can't allow a buyer to wait you out so you become a desperate seller. At the end of the day, you want this to be a very diligent process that stays in a timeline of finishing due diligence, but creates a sense of urgency. That's how you can push to get a better price. Number two is building your brand. In a perfect world, you'd be able to uplist on the New York Stock Exchange and get investment banks behind you and truly capitalize on these companies. But right now, you have to stay flexible because that's a policy driven and something that you can't control. So we're either going to have to stand alone or try to position to be the most attractive takeover target there is. In the meantime, you can boost your firm's appeal by beefing up your brand. As the price of cannabis declines, brands are critical to commanding higher consumer demand and price. Product consistency and authenticity are key attributes to building a strong brand. You can embed your business and products in key markets that will be attractive to potential suitors. Once there, you can saturate the market. Number three is determining what your business is worth. It sounds simple, but it takes a lot of work. You need to price out the opportunity. What is your firm's potential cash flow? It's the line items acquirers are often most interested in. Accountants and business brokers can help you crunch these numbers by using common ratios that take into account the possible revenue multiple or profit multiple to price your company depending on the particular business sector. You can compare other deals. So if your firm is in a hot merger or an acquisition target, it's likely others in that sector are too. So take note of those deals involving companies comparable to your own. You build a network of investment bankers and brokers that are actively engaged in deals in your market. Network closely with other entrepreneurs and business owners in your sector. Talk up your company's valuation on a regular basis when speaking with investors and executives. The big mistake is to never talk about your worth and valuation when the surprise stakeholders bring it up. I would also add that one of the biggest mistakes is to have pre-money valuation in the millions of dollars. You have no brand if you have no sales. So if you think that you're worth $1 or $2 million because you have a cool logo and you have no sales, you're going to scare everybody away. So that valuation is incredibly important. Number four is putting good corporate governance in place. So for companies actively seeking a buyer, having corporate governance basics in order is a must. You want to make sure that your lawyer is engaged and that if there's any votes or actions or adjustments that for your financials, make sure everything is well documented. If not, it's a signal to an acquirer that something may be out of line. So a potential acquirer will likely pause if the following controls or considerations are unaccounted for. So you need to have updated, audited financials. You want to avoid creating headaches for your potential acquirer by having your financial house in order. That includes up-to-date balance sheets and audited financials. Your corporate governance controls. You need to be prepared to show that you have strong controls in place, including updated board minutes, documentations of all board votes and decisions, and have good shareholder communications, whether you have a wide shareholder base or a large shareholder. Be prepared to show that you've been in regular contact with your key investments and shareholders. And number five is hiring the right business broker. Beyond the team of auditors, accountants, and attorneys needed to help craft your deal, a business broker can help be an invaluable asset. Be particularly choosy when hiring a business broker. Cannabis has legal and regulatory baggage that makes it different from any mainstream industry. Cannabis is not a normal market. It's a 30-plus market across the U.S. that all have different laws to abide by. You really want somebody that has significant experience in this space and understands the challenges of buying and selling companies in this industry. When choosing a broker, ensure that the broker is licensed by the Financial Industry Regulatory Authority, or FINRA, which governs best practices and regulates broker-dealers. Seek experience. Consider the number of deals any broker has completed in the cannabis space, but be sure to ask to speak with past clients. And keep an eye on the cost. Be aware that most brokers require retainer fees that can range from $25,000 to $75,000, depending on the size of your firm. That can be in addition to success fees, which are paid out once the company is sold, and those range from 2 to 5%. Beyond creating competition among buyers, brokers are critical in helping to carry out the due diligence needed to ensure that potential acquirer is in the right fit and helping outline the deal structure to ensure that you get the best price. Cash up front is the most important factor. If they're offering stock, is it public or private? What carries the most value to you? Many buyers will push to work in certain benchmarks that trigger payment to a seller at the end of the deal. The structure of those considerations is critical. Some are questioning whether the cannabis company's profits are up in smoke. There's been some questionable accounting practices that have allowed cannabis companies to inflate their profits. Some cannabis companies do in fact make fairly reasonable assumptions in valuing these assets given the guidelines they're working with, and price to earnings multiples are effectively meaningless for these companies. There's been a positive shift in financial reporting. However, there's concerns about how the International Financial Reporting Standards, or IFRS, can inflate profits. The issue with cannabis companies using these international standards is that the plants are still in the ground. They could perish in a drought, drown in rainstorms, be eaten by bugs. These are problems, and if any of these events were to occur, a company that looks profitable on paper could immediately lose all of its value. So these risks are present in every agricultural sector, but with cannabis, because it's such a new industry, there's often overlooked inconsistencies in the way that cannabis producers arrive at the fair market value of their crops. And with that, we're going to roll this one up. If you want to like and subscribe and share, please do. If not, I'm out.